the markets, the markets reaching record heights and also record valuations. How does the Fed think about that in the equation?
Financial markets? So obviously we monitor financial markets very carefully. Our policy works through financial conditions. So that's credit spreads and interest rate levels and equity prices in the aggregate that can affect spending, for example. We look at all of that, but really our focus is on our two goals, and that is maximum employment and price stability. And when we see one of them weakening, we're going to respond appropriately with our tools. And in this case, that meant reducing the federal funds rate by 25 basis points. And we'll see what the future brings, but that's what we do. We look carefully at financial conditions, more from a perspective, though, of financial stability. So we see that the banks are well capitalized. Actually, in the aggregate, households are in good shape financially. I know people at the bottom end of the income spectrum are under pressure. No question about that, but it's not a time of elevated financial stability risks.
Mm-hmm. So the federal funds rate really governs consumer credit, but not so as it pertains to mortgage rates, correct?
That's right.
And let's talk about how the average consumer is going to see any difference in the intervening months relative to an easing of interest rates and the ability and maybe even more confidence to spend.
So we don't set mortgage rates, but when we change the federal funds rate, it will affect the mortgage rates and also all other consumer borrowing rates. Really, all interest rates that are on a floating basis will move a little bit or even a lot if they're short term, based on our moves. So the people will feel that over time. Also, it's not just these days. The market is pricing in the next 6 months what's going to happen to rates. So this is something that wasn't really the case 50 years ago. Now markets listen to us and follow, and they make an estimation of where they think rates are going, and so they'll price things in. And so longer term rates will move because of what the market participants expect us to do. So you'll begin to see, and you're already seeing changes in rates long before we make the decision. It can often be already priced in.
Is it fair to say that the Fed and the markets really have a higher tolerance for risk today, more so than perhaps before the pandemic?
I think if you look at some prices, then they're elevated relative to historical levels. There were times before the pandemic when it happens periodically. Equity prices will move up and down, and we do monitor that. But we're not targeting any level of prices for particular financial assets. We don't have a view that we know what the right price of any particular financial asset is. We do look at overall financial conditions, and we